Okay, this is Chapter 2, Financial Statements, Taxes, and Cash Flow. In this chapter, we're going to be talking about the difference between accounting value or book value, in other words, what has been recorded in the accounting records, and market value, which is a whole different calculation. We're going to distinguish between accounting income from cash flow. And again, those are totally two different measures. We're going to talk about the differences between average and marginal tax rates. And then we're going to determine a firm's cash flow from its financial statements. Okay, so the first thing we're going to do is we're going to talk about the balance sheet, the income statement, taxes, and then cash flow. Okay. The balance sheet. The balance sheet is a snapshot of the firm's assets and liabilities at a given point in time. So when you see a balance sheet, what the company did was they stopped recording all transactions and they determined what the balance in each one of the accounts on the balance sheet is and listed it. So for example, they would have taken the balance in the cash accounts at that point in time. They would have looked at the balance in the inventory account at that point in time. They would have looked at the balance in accounts payable at that point in time. So it is looking at the firm's assets and liabilities at any given point in time. If you remember from financial accounting, assets are those things that provide future benefit to the firm. So there are things like cash, there are things like piece of equipment, accounts receivable. We're going to get the cash from the customers when they pay us. Those are all things that are going to provide future benefit to the firm. When you look at an a balance sheet, you're going to find assets are typically shown in the upper left-hand side or the upper portion of the balance sheet. And they are shown in order of decreasing liquidity. What that means is how quickly we can convert those assets into cash. So naturally, cash would be first because it's already converted into cash. And then when you move down the balance sheet for assets, you will see that things that would take longer to convert into cash are listed later in the list of assets. Liabilities and owner's equity. If you remember from financial accounting, assets have to equal liabilities and owner's equity. They're on the right-hand side portion of the balance sheet or the lower portion if the balance sheet is showed from top to bottom. And in this case, it's an ascending order of when they're due to be paid. So in other words, the liabilities that we owe and are going to have to pay for the soonest are going to be the ones that top the list. And when we're all done, the balance sheet identity should be assets equal liability plus owner's equity. Okay, the total value of the assets are equal to the current assets plus the fixed assets. Current assets are things like cash, accounts receivable, inventories, investments. Fixed assets are things like tangible fixed assets, which would be property, plant, and equipment, buildings, land, equipment, and then intangible fixed assets, which are things like patents, computer software, some things like that. On the other side of the balance sheet are your liabilities and your equity. Your liabilities consist of current liabilities, and that would be things like accounts payable. It would be the current portion of long-term debt. You have a mortgage on a property and you're paying back the bank. What you owe the bank this year would be a current liability. Then there's long-term debt, and then the rest is shareholders' equity. Net working capital is current assets minus current liabilities. Okay, so I just got through saying net working capital is current assets minus current liabilities. In a healthy firm, it's usually a positive number because you need more assets to pay. Those assets are needed to pay off the liabilities. If it's not a positive number, then you're going to have problems paying your bills, and that's going to put the firm in a dangerous position. Liquidity is the speed and ease of conversion to cash without significant loss of value. And it's very valuable in avoiding financial distress. So you would want to have a certain amount of liquidity available to the firm. And then finally, the firm is supported and provided by debt versus equity. Equity is more expensive because the shareholders expect a higher rate of return because they have more risk than the debt holders. In the case of a company going bankrupt or going belly up, all the debt holders would be paid first, and then if there's anything left over, they would pay to the equity or the shareholders. So because of that, the shareholders expect a higher rate of return on their investment than the debt holders would. And this is an example of a balance sheet of a fictitious corporation. You can see this one is shown from left to right, and you'll see the current assets, cash, accounts receivable, inventory, and then a total current assets, and then fixed assets, and then you add those two together, and that gives you total assets. You notice that it has 2 years listed, 2018 and 2019. It's required to have a listing of 2 years. Liabilities and owner's equity. First at the top there's liabilities. You can see accounts payable, notes payable, total current liabilities. Then you're going to have long-term debt. That would be things like bond, mortgages, things that will be paid over many years. And then you're going to have your stock, common stock, and retained earnings. Retained earnings are the earnings, the income that the business made over the year that has not been paid out in dividends to the shareholders. It's remained in the company for the company to reinvest in itself and grow. Okay, the idea of book value versus market value. Book value is the balance sheet value of the assets, liabilities, and equity. So in financial accounting, if you can remember back then, you made all kinds of journal entries. Those journal entries will reflect, when they're all put into the system and accumulated, the book value of the company. However, the market value is a very different number. The market value is the price at which the assets, liabilities, or equity can actually be bought and sold. They're often very, very different, and they're different for a number of reasons. For example, assets. When you buy an asset, it is purchased and placed on the books at cost, whatever you paid for it. And even though the value of that asset grows over the year, we don't typically adjust the value of the asset on the books. Let me give you an example. Let's say we're an old company, and in the year 1900, we went out and bought a acre of land in downtown Manhattan in New York City. That acre of land, maybe we paid $5,000 for. Today, and that's what we would have recorded it on the books. We would have debited land for $5,000, credited cash for $5,000. Today, the value of that land would be worth millions. Well, in our accounting records, it's still listed at the cost that we paid for it, that $5,000. So the market value is much higher because we own that piece of land. And then it asks you, which is more important to the decision-making process? Well, if you click on this little button, it's going to ask you and give you a couple little quiz questions. And it says, what is the difference between book and market value? And which should be used for decision-making purposes? What is the difference between accounting income and cash flow? And which do we need when we're making decisions? Okay, so let me see if I can get us back to the previous slide. Oh, the first question was really the one we were looking at. Let me get you back to that one. And basically, we should be using, let me get us there. Okay, which one is more important to the decision-making process? I would strongly say that the market value is more important because it's the actual worth, the true value of the firm. Okay, so here's an example. The Klingon Corporation has fixed assets with a book value of $700 and an appraised market value of $1,000. So what that means is when they recorded it, they bought these assets, they paid $700 for them, but now those assets are worth $1,000. They've grown in value. The current assets are on the books at $400, but approximately $600 would be realized if they were liquidated. Klingon has $500,000 in long-term debt, both book and market value, and no current liabilities of any kind. What is the book value of the equity? Okay, and so if we look at the book value, what we would do is we would take the total assets, the cash and the net fixed assets of $1,100. We would subtract the $500 in long-term debt, and that gives us $600,000 in equity, shareholders' equity. From the market standpoint, we would take the total market value of $1,600, subtract the $500,000 in debt, and that would give us $1,100 in shareholders' equity. So the shareholders' equity is worth almost twice as much than what is shown on the books. And that happens very frequently. Okay, the income statement. The income statement measures performance over a specific period of time. Typically, income statements are shown for a year, but they can also be shown for a quarter or monthly statements. Revenues are reported first, and then any expenses for the period are deducted. Once you take revenues minus expenses, that gives you net income, or what some people refer to as the bottom line. Dividends are paid to shareholders. Dividends are not part of the net income calculation. Dividends come out of retained earnings. And net income is an addition to retained earnings. So if you had to write an equation for the income statement, it is net income equals revenues minus expenses. Okay, and this is an example of a U.S. corporation income statement. It's got net sales, and then it's got expenses, cost of goods sold. This is a firm that sells goods, and so the $750,000 is what it costs them to either buy or manufacture the goods that they sold. There's depreciation. I'm going to subtract those things from net sales. So if we take net sales minus cost of goods sold minus depreciation, that's going to give you earnings before interest and taxes. From that, we're going to subtract interest paid, which gives you taxable income. Then they're going to deduct taxes, which for this particular example is 21%. So we're going to take 21% of $600 million, and that gives us $126 million in taxes. Or I'm sorry, $126 million in taxes, giving us $474 million in income. Taxable income minus taxes gives us net income. What they did was, out of that $464 million goes in one of two places. Dividends of $165,000. That's actually cash that is given back to the shareholders as a form of a return on their investment. And what they haven't given back to the shareholders out of that $474,000. So if I take 474 minus the 165, that gives us 309,000. That goes into retained earnings, and it increases the balance in retained earnings. Think of the name of retained earnings. Retained earnings. It's the earnings that we retain in the business. It's not given to the shareholders. Okay, the financial statements, just a couple things. First of all, GAAP, the matching principle. I don't know how many of you remember the idea of GAAP, GAAP, from financial accounting, generally accepted accounting principles. And basically what GAAP says, the matching principle says that revenues and expenses are recognized. Revenue is recognized when it's earned, and expenses are recognized in the period in which the revenue is generated. So we want to make sure that if we sell a car, if we're GM and we sell a car, that all the cost of the car to make it show up in the same period as the revenues that we earned when the car was sold, because then that gives us a true picture of what's going on in the business. In order to make that happen, we have to use accrual accounting, and we have some non-cash items. And those non-cash items are expenses that are charged against revenue that do not actually affect cash flow. One of the most important of those is depreciation. Okay, time and cost, variable and fixed costs are not obvious on the financial statement or the income statement. You know, we don't have a measure on the income statement to indicate the time period in which the costs are incurred. The idea of earnings management, basically what happens in earnings management is management likes to show steady increases in net income for the company. So what sometimes they will do is they will make decisions that manage earnings or make it appear as if they're steadily building income, when in fact that may not be the case. There is some wiggle room to do this with GAAP, but it's something that is frowned upon in general and can lead to big problems. You know, that was one of the reasons why Enron fell apart, was they were managing earnings and they were trying to make themselves look better and better and better every year, and just got caught in a web that couldn't be undone. Global standards, accounting standards are trying to be globalized through the International Financial Standards Board, and they are slightly different. Well, they are different than GAAP, but there's more and more being done to make sure U.S. GAAP and international GAAP are both on the same page. It's going to take a long time to do that, but we're attempting to make that happen. Okay, here's an example that might be fun for you to do. Publicly traded companies must file regular reports with the Securities and Exchange Commission, and those reports are found on an SEC website called EDGAR. Okay, you know, if you do, when you go under, you can click on the link and it'll take you there. You can also go to sec.gov, and that will take you where you need to be. This is international accounting standards. That's not really where I want to be. Okay, let's go in and do sec.gov. I don't know why that link's taking us to something totally different. All right, and we can go do a company search, and we can just say Ford Motor Company and do a search for that. And the company search has to be pretty precise. Let's just try Ford. Okay, now you can see there's all kinds of companies by the name of Ford, and we would scroll down until we found Ford Motor Company, and it will allow us to go in and get information about the Ford Motor Company. All right, come on. Let's see if I can get there. Okay, Ford Motor Company, motor vehicles and transport cars. So it, you know, here when you go there, going to the SEC website, it gives you all kinds of documentation that has been required to be submitted. An 8K, if we click on that, An 8K is an other event. So if there's certain things that they have to report if they happen during the period. So that's what an 8K is. Let me see here. There's some of these I'm not familiar with. A 10Q is a quarterly financial statement. Come on. And you should be able to click on that, and it's going to give you information on the Ford Motor Company and what the different statements and things that they have. So there's a ton of information available on the SEC website. Okay, I'm going to stop this video right here because I'm not going to be able to do it all in one, and I'll pick up here in the next video.